This regional bank is next. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, another regional bank is on the cusp of failure and desperate for a major bailout. And I'm going to show you in today's show why this is just the beginning and more banks are going to fail. We've talked about the problem the banks have, but what we haven't discussed is why this is going to get worse despite efforts from policymakers and the government to put an end to this, why they can't do it. Plus, we have news out of Europe that a major bank that we talked about in yesterday's show just got a bailout and why that's not going to make any difference in their problem. Plus, we have a sponsor for today's show. This biotech company just had a major announcement today. They wanted you to hear about it, and I'm going to show you why I think their stock could move 30% or more here in the short term and why even higher based on the news they released today. Stay tuned to the end of the show for more information or check out the pinned comment and in the description below. Now, let's head over to Bloomberg because I want to set up, this situation with this regional bank and why for all these other regional banks the problems are only going to get worse. First Republic extends route as the bank is said to weigh options. This morning, shares fall as much as 39% in pre-market trading as the lender said to exploring strategic options, including a sale. And this is a problem. When you see the share price crash, they're trying to actually bring in investors to bring in money. And when your stock price is crashing, people tend to go the other direction, now leading them to look for a sale and try to save the bank. But notably, as we'll see, this is maybe just a temporary fix in what will be other banks that will soon follow, and there won't be enough money for all of them. Normally, a headline of a potential sale would support the stock. However, the potentially significant deposit outflows post Silicon Valley Bank failure are likely to leave this bank in a tough spot. And that's the real issue here, is not that we're just going to see deposit outflows. It's actually the mechanics of the financial system that I want you to see here in a little bit that are going to actually indicate that these outflows are going to come no matter what, because there isn't enough new money coming into the banking system to support everyone anymore. On Wednesday, First Republic shares sank 21% as its credit rating was cut to junk by S&P Global and Fitch Ratings. And of course, that actually doesn't get people excited about investing in the bank, who said that they still have about $70 billion in unused liquidity from agreements from the Federal Reserve and JP Morgan Chase. And notably, when you take money from the Fed, it has a negative stigma here. And so that actually seems like what would be a strong suit, saying, look, we have these untapped credit lines. But investors and depositors say, hey, you know what? If you've got to go to them for money, well, maybe you shouldn't have mine anymore. First Republic specialized in private banking and wealth management, but get this, there's some other regional bank peers that we should be watching for next. PacWest Bancorp dropped 17% in pre-market trading. New York Times and Western Alliance Bancorp slid 10%. These banks will be next on the potential list. Because what's going to save here, this bank potentially save First Republic? We just got some breaking news from the Wall Street Journal that says they're in talks with JP Morgan and Morgan Stanley and some others to bolster the bank, including a potential capital raise. And so, of course, the market really likes this news a bit, and it really helped out. But what I want you to see is this isn't going to matter. You can fix one, but the ship is leaking. There's holes all across the hull, and you can start to try to plug them, but it won't fix the overall problem because it's deeper than what most people realize. And now I want you to understand, what we're going to talk about the money supply here for a moment. But before we get to that, those of you who don't understand what this is, let's take a look at what the money supply is, and then let's look at this chart, because what you're going to see is a contraction in the money supply, and what that means is there isn't enough money for all of these banks to survive. Someone has to go. Some will get bailed out, and some will just fail. So the M2, you see here, this from the Federal Reserve beginning May of 2020, includes small-time deposits of less than $100,000 and balances in retail money market funds, including the M1. And so here we see the broad money supply, what's called the M2, and this is all the history that we see on the St. Louis Fed website. Now, it does go back even further, and there's some other people who have charted it, but based on what we have available, you'll notice that it has never contracted here since the the 1960s, and notably we're seeing a contraction in the money supply now. So what I want you to take this away as, think of it as a game of musical chairs. You've got 6 players and 5 chairs, and what does that mean? Someone is going to lose when the music stops. This is what you're seeing in the banking system. What is the problem the banks have right now? Not only are they competing with the Fed for deposits, but they need deposits. They need money to come into the bank. So if the money supply is contracting, what is it telling us? There's fewer chairs in the banking system, and that doesn't work because even if you bail out some of them, there isn't enough money to bail out all of them. And of course, many of you might be suggesting is, hey, is this due to the Fed? Well, let's talk about the Fed's relationship in the money supply here, because many people believe there is a relationship to that in the monetary base, or the total amount of currency that is either in general circulation in the hands of the public or in the form of commercial bank deposits held in central bank reserves. So as we look at the actions of the Fed, it's not so much the federal funds rate we're interested in now. We're actually shifting to look at what happens when the Fed does large-scale asset purchase programs, or what is referred to as quantitative easing, or the opposite, as we're doing now, quantitative tightening. So many people say, hey, the Fed is the one driving the money supply negative here by doing quantitative tightening. And keep in mind, if that is true, and we'll have some evidence to support that here momentarily. Remember, the Fed said its primary policy tool is the funds rate, meaning even if they pause or start to cut, their plan is to let this QT program continue to run. But maybe if the banks keep blowing up, they won't do it a whole lot longer. And here you can see in this chart, we have the M2 against the monetary base shown in red. And normally you don't see virtually any relationship between the two because, well, there really shouldn't be. But notably, when you do see, of course, QE, big bursts of QE, it does have an effect on the money supply because that's what it's designed to do. But smaller amounts don't seem to matter. And so here you can see this big burst, and then the money supply slows down. Of course, the Fed's year-over-year rate of change in the monetary base comes down with it. We notably here was quantitative tightening, which at first really didn't have much of an impact, and then later did as it got larger in size. You see here again QE having a major impact and QT having, of course, the opposite because we're doing quite a sizable amount, around $60 billion a month. And so it is having an impact here. So even if the Fed were to stop raising the funds rate but continue doing quantitative tightening, it's likely we'll continue to see one bank after another run into problem after problem until it runs out of people who can bail them out. And that's the point where the Fed starts to capitulate. Of course, now we look over to Europe, and what do we see? Well, we don't see any capitulation there amidst a massive crisis with Credit Suisse. As the ECB delivers half-point hike but gives no signs on the next move, leaving many to wonder why you would raise the rate from 2.5% to 3% in the midst of the fact that Credit Suisse, one of the biggest banks in Europe, is now needing a bailout and has actually gone and got some money. And now let's take a look at this because it's only going to get worse. Of course, Credit Suisse, they don't get the problem either. They need deposits, and this isn't the answer. As Credit Suisse seeks circuit breaker with $54 billion backstop, as top shareholder says panic around the stock is unwarranted. Of course, yesterday we heard that they weren't actually doing this, but of course I think we now know they didn't want people to know they were after a bailout, as they sought to arrest a collapse in investor confidence on Thursday by opening a 50 billion Swiss franc credit line with the country's central bank and offering to buy back debt as executives and government officials plot the next steps for Credit Suisse. And now you might be wondering, why would they want to buy all of this debt back? Well, because the market had priced it as pretty much distressed and about to go insolvent. As you can see here, these are credit default swaps. You may remember these things from the great financial crisis. And sure enough, they're blowing out, suggesting that as insurance on the bonds is indicating that Credit Suisse was in no position to pay this money back. So what do? They go to the central bank, they borrow some money and say, look, we'll start buying this debt back, which obviously from one standpoint will be cheaper for them to buy back now in hopes that perhaps the bank stays solvent and they could later sell that debt at a higher rate than they just bought it. but the stigma, the fact that they had to go to the central bank tells you everything about the problem here, because the issue here is deposits are flowing out of the banking system. There isn't just enough money for everybody. And we talked about how Credit Suisse was offering these teaser rates to get deposits in. Now they go to the central bank. Well, you can only imagine if depositors now are seeing that, they're probably not coming back. And yet shares in Credit Suisse surged as much as 40%, only to pull back most of that in early trading, along with the repurchase of up to 3 billion francs in dollar and euro denominated debt. The bank arranged for collateralized credit line with the Swiss National Bank after a record slump in the share price, as we said would likely happen. The bank, though, has said they have not yet needed to use this facility for liquidity, but of course, as we know, that's likely to come soon, because here's what you can see from one of their largest investors is saying, their top shareholder, that, quote, everything is fine and the bank isn't likely to seek more capital in the days following here. Of course, as we know, when you hear someone tell you that, hey, they don't need any more money, that everything is fine, which is what Credit Suisse told us the other day, that, hey, we're okay, we're not actually talking to the central bank. Well, it turns out they were, and we know that that means something worse is likely to come, and why you're going to see Credit Suisse in the news in the future when they don't figure it out. It's not an issue of their debt being distressed. It's an issue of deposits and a contraction in the money supply. It just isn't going to work. But one thing that is going to work is we'll take a look at our sponsor for today's show. This is Clear Mind Medicine, symbol CMND. Some of you may remember them. They've been a sponsor on the show before, and they develop breakthrough treatments for binge behavior and mental health, including alcohol use disorder and binge eating and depression. And what's so great about what they're doing now is they just came out with a major release. I want to show you what that is and then show you why I think the stock is poised to have a really big move here in the short term. And depending on how this trial goes, it could go a whole lot higher. Let's dig a little deeper into ClearMind again. Symbol CMND. Put them on your watch list for sure. And what are they known for? Is their MEAI, a new psychoactive molecule that exerts a euphoric alcohol-like experience and a reduced desire to consume alcoholic beverages, with potential to change the lives of millions who struggle to drink in moderation. And here's what they announced today. That's right, this morning, they announced that they put in their application with the U.S. FDA requesting approval to initiate its first in-human phase 1 and 2A clinical trial with CMND 100, which is their MEAI, their novel psychoactive molecule that's been reported to reduce the desire to consume alcoholic beverages. So they wanted to get the word out. They want people to know about this. And from a stock perspective, what we're really interested in is what's the potential upside move? Because if this clinical trial goes well, of course, that's going to be big business for ClearMind. In the short term, though, because they're going to launch this hopefully in the second quarter. But from a stock perspective, what we like to see is they've got a really low float, about 1.2 million shares, this according to FinViz. And now let's take a look at some charts here, because when we look at the 6-month chart, from a technical perspective, what are we seeing? A breakout in the MACD, looking like it's going to break over and into positive territory here. We see a positive cross moving higher as momentum moves up. We see the RSI momentum is positive, and we've noticed it got rejected here before at the volume profile line. But what I think can happen here is you'll notice the other day it had this big move up to about $5. Well, if you see this low float stock get some movement here and surge higher, you're talking a 30 to 38% move back up to this high, which I think in the short term can happen, because if you notice the trend in stock price is moving higher, the technicals are moving higher, it's holding support around its 21-day moving average, which is the red line, and a breakthrough of that volume profile and a squeeze of these shorts is going to send this thing higher. Now, as we zoom in to the 90-day chart, what do we see? The MACD had a little bit of a pullback here on the stock price coming down, and now it's flattening out, looking to move higher. We see momentum slow, but still remain positive at 46, and is now looking to move higher on the RSI. As we zoom in even further, what do we see on the 30-day chart? A positive cross on the MACD. What do we see? Momentum remaining at 45 on the RSI. So we're seeing this pull pullback here, and now what is the beginning of a second move higher in the stock price. And now let's take a look at what we think here is what I think is a potential 30 to 38% move higher in Clearvine, just based on this news alone and the fact that their share price is so low compared to the amount of shares available to trade. So before you do anything, remember their symbol CMND, put them on your hot list. We got a link to their website, a link to the analyst report, and a link to that report about their news and the clinical trials. Check it all out, and let's just see what happens here. Again, before you make any trades, do your research. CMND. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.